economic slowdown, and with that slowdown, we're expecting inflation to also come down.
Pretty much everyone is expecting a recession.
Right now, the labor market doesn't look like it's on the verge of a recession. In fact, it looks like a market that still needs people to come off the sidelines.
We do think the peak in inflation is behind us, but inflation is likely to remain elevated into the first half of next year.
Any acceleration in 2023 from this year is going to be quite grudging, and it's just not going to be broad-based.
We think that they'll probably start cutting rates in December of next year.
So there's a lot that people sort of disagree on going into this year. When will the Fed start to slow down? How much will the economy actually slow down? But directionally, there's an enormous amount of agreement, right? Inflation is going to start to decelerate, and we are going to see the economy really decelerate as well as the Fed interest rate increases start to bite. I took a look back at the end of 2021 to see what the predictions were like for this year. I wrote about it in today's morning brief. You always get strategists like making their forecast, then they adjust throughout the year. But the forecast that they make going into a new year, they tend to not be spot on, of course. And so now as we look ahead to 2023 and you look at the forecast, I think the median forecast is somewhere around 4,000 for the S&P 500 is what we're looking at now. 4,009 is the average here. So we'll see where we actually end up. An anemic increase is what most strategists are looking for.
Yeah, I think if there are two things in terms of where the Fed is going to be focusing or continuing to focus its attention and taking it from that perspective of their dual mandate and looking at employment and then looking at pricing. On prices and price stability, it's really a matter of where you see the stickiest areas of inflation within prices starting to retrace a bit. And that's around necessities. That's everything from what you're paying to fill up the gas tank, but also what you're paying on your electricity, what you're paying just in your housing. And so with all of that, it's going to be the continued deceleration in price increases there, and then the retracement, hopefully, of some of those prices as well, so that consumers can feel a tad bit better, at least year over year. But we're going to have to see a trend lock in place there. And in unemployment, they've said that, look, they're willing to, or at least expecting to see unemployment and the unemployment rate tick up, as a recession is a very real kind of inevitability that many economists that we've discussed, as you saw through that clip, had pointed out. And so within those dual mandates that the Fed does have, I think those are the two key areas that the market, within any data that we continue to get, is going to latch onto, just looking for a trend. And what that trend is, whether it's 3 months or 5 months, that's exactly where we could see some actual reaction from the equity markets here too.
Yeah, two things come to mind. Listen to those comments.
What's going on, family? This is not financial advice, man, as you know, but we can trade in any market. So regardless of what's happening in the market prediction throughout the year, they're not spot on, but they tend to adjust their prediction throughout the year. But we're still in a bear market. We're still in a large downtrend. We still have gaps to fill. We still have a lot of inflation. In this period of stagflation, we got a recession. People are calling for a recession. We also have the interest rates. Interest rate hike is still in effect. They have not stopped with the rate hikes, and inflation is here to stay for a period of time. So oil could be going back up for a short period. But we'll see what happens in 23. So just to keep this in mind, man, we can trade in any market where the market goes up or down, man. That's the beauty of it. I'll see you guys in the trading room. Out.